Welcome to Markets Now. I'm Michelle Rook along with Arlan Suderman with StoneX Group, and we did have a lower close in the grains today with the livestock futures lower and hogs kind of mixed in the cattle market. But Arlan, it felt like a risk-off day here today, and that was kind of the theme for the week, wasn't it?
It really was. We saw energy prices trying to go higher on Friday, and that was largely because they were near the bottom of a trading range that the markets really held pretty true to for the last several months. Outside of that, stocks were lower. There's a big down day there. Grain and oilseed markets, the protein sector tried to hold up, led by cattle, but just wasn't able to. The headwinds became too significant, and by the end of the day, they went lower as well. And the big concern is, are we going into a deeper recession led by the Federal Reserve actions? The data that came out showed hotter than expected inflation. In fact, not only hotter than expected, but showing increases in inflationary pressure over the previous month and over the previous 2 months. And that suggests that the Fed may have to get more aggressive in its monetary tightening, which could put more pressure on the economy. And funds managers worry that could reduce demand for commodities. You can argue whether that's the case with the food-based commodities, but it is their perception, and
Yeah.
perception is reality when you have the kind of money they have.
Yeah, PCE at 4.7%. That's the key one that the Fed kind of watches, isn't it?
It really is. They like that core PCE that excludes food and energy. And what today's data showed is really that this inflation is not just founded in the food and energy sectors, not just in the commodity sectors, but it's getting more deeply ingrained, or we call it the stickiness of the inflation in our economy. And we had several Fed members at the last meeting showed up in the minutes this week who felt like we needed to be more aggressive with 50 basis point rate hikes instead of 25 in order to get rid of that stickiness. This will add more fodder to their arguments.
No doubt. So we had lower weekly closes and everything, and especially ugly week in the wheat market. Funds have started this liquidation train. Do you think they're going to continue?
Yeah, I think so. Well, so much of our trading happens now with the algos, which are simply reading the chart signals, momentum to the downside. If we see a pause in it, and that could be simply a headline that raises concerns about commodities, any headline could kind of make that shift. Then we could see things turn around the other side. But until that happens, there's nothing to turn them around. What's working is will continue to do happen until it doesn't work. And so right now the downside is the path of least resistance. We got to watch that 650 level in
Mm.
corn. That's a key support level. That gives way. We could see some more technical selling come there as well.
Yeah, that's very key support. What about wheat, though? Wheat had a horrible weekly closes, down 40 to 60 cents. What support areas are you kind of watching there?
Yeah, that's really kind of in an air bubble right now, trying to find some areas of support. And ironically, this happened in a week when we were having some tremendous dust storms in the southwestern plains, and that area remains very dry in the forecast, so no sign. At some point, the market could start focusing on that. We're starting to break dormancy on what crop is up in that area of Texas and Oklahoma, getting up into southern Kansas. That means moisture demands are going to go up. That means more dust storms if we don't get moisture in that area. So that could capture some headlines at some point. But right now, the market doesn't care. We also see things escalating in the Black Sea. We celebrated the 1 year anniversary of Russia invading Ukraine, a non market event today. We've
Yeah.
removed the risk premium, the war premium, so to speak, from that market. It just doesn't care right now. And so the momentum's to the downside until something turns it.
Yeah, it's hard to believe that we are at levels on prices for wheat below where we were when the war started.
It's as if it didn't happen.
Yeah.
And we know that Ukraine's ability to produce and export is limited at this point, and that's starting to put a lid on what Russia can as well. But nobody is really feeling the pain of that right now. We're getting by, and so the market doesn't care until something happens to wake up to the reality. Hey, we're still kind of tight on supplies.
Hmm. And soybeans kind of held up better than corn and beans because we were still trying to hold in some weather premium there from South America. And we did see a drop in Argentinian crop ratings and estimates this week, didn't we?
Yeah, yeah. What's amazing, if you use USDA's numbers, with the drought in Argentina and the bumper crop in Brazil, all of South America, with Paraguay and Uruguay included as well, is still up around 26 million metric tons from year ago level in soybean production. Now, the Argentine crop is bound to get smaller. Buenos Aires Grain Exchange is down to 33.5 million metric tons. USDA is at 41. And my contacts down there think that 33 is probably the top end of the crop. It's probably smaller than that, and maybe even 30 or lower. On the corn side, they came in at 41 million metric ton. USDA is at 47. That should directly help U.S. exports over the next several months. So far, that hasn't happened. The market says prove it, and it's skeptical until that happens. On the soybean side, we're still going to have a bigger crop than last year in South
Right.
America. It's just a matter of logistics. Will the margins, meaning will soy meal prices be high enough to pay the freight to import those soybeans south into Argentina to crush them? That's going to be the question. If not, that significantly increases demand for U.S. meal. If the margins are good enough, then it doesn't have much effect at all on U.S. meal, and this market can break lower.
So you mentioned USDA Ag Outlook Forum. Obviously, we saw an increase in acreage for all three primary crops and increased ending stocks into next year. Did that really have much of a bearing on this market, or was it the other things that we talked about earlier?
Yeah, I think the trade, as much hoopla is made about the Outlook Forum, the trade understands there's only really one number that matters out of that Outlook Forum, and that's the yield estimates. Because in 8 out of the last 9 years, USDA has taken the yield from the Outlook Forum and put it in its first new crop balance sheet published in the May crop report. And a 181.5 for corn, 52 for soybeans, both of those would be record yields. That 181.5, it would be almost 5 bushels above the previous record. Both of those are above a 30-year straight line trend yield. Will it happen? It might, not because that's necessarily a good calculation of trend yields, but because we're moving into an El Nino year, which tends
Right.
to favor yields. And so, therefore, we have to use that number. The market will trade it come May. Outside of that, almost everything else that USDA released this week will change. The demand estimates will change by May. The production numbers will change. The acreage number, which gets a lot of play, doesn't come from any farmer surveys. That
No.
farmer survey happens this coming week, but will be published on March 31, and that's what will be in the May report. But yet everyone's talking about it.
Yeah, I know. It does get a lot of headlines. All right. Thanks so much for joining us. Arlan Suderman with StoneX Group, and that is Markets Now.